Um, Apologies for the delay. Um, so thanks for joining us today. We'll give it, I guess, a couple more minutes for everyone else to join. But just to let you know, we've got two upcoming deals on our platform. The first one is Green Lagoon, which is basically what they do is they deal with renewable energy, and they capture the biogas that is released from the palm oil milling industry and convert that into renewable energy. And the second one we have is QMAT, which is a health tech startup, and they do all sorts of solutions for doctors and patients. So if you'd like to check them out, you can go to our website, and there are more details over there. And I believe the link is in the chat as well. Okay, cool. So thanks everyone once again for joining us today. Today we've got Izwan from Izwan and Partners joining us in our Angel Investor Insight series. So a bit of background to this series. We get different sort of angel investors to come and speak in these sessions. And so for today we have Izwan who would, I guess, give us some insights into the legal aspects that comes into play when you invest in startups. Um, so a bit about Leet Capital. So we're one of the 10 licensed ECF operators in Malaysia. We're actually the latest one. We started our platform in Q1 of 2020. So still relatively new compared to the other players in the market. And what's unique about us is that we're part of the Leet Ventures ecosystem. So for those of you who don't know, Leet Ventures or 1337 Ventures is an early stage VC venture capital. So we do run accelerator programs, and we invest in early stage startups as well. So currently we have a portfolio of about 25 startups ranging from different sort of industries. And so we started Leet Capital to sort of complete that entire ecosystem in terms of helping this more later stage startups and SMEs scale and grow. So what is ECF? I think the last time we had this session, we realized that not a lot of people are aware of ECF or have even invested in the private equity space. So just to give you a bit of context as to what is ECF, ECF is basically a means now to allow the public, i.e. yourself, myself, to invest in these private companies. Previously investing in private companies was only available to these high net worth individuals, these angel investors and sophisticated investors. So now with ECF, you can invest in your favorite local coffee shop or your favorite grocery shop, stuff like that. It's giving you the opportunity to invest in these private companies. And the unique thing that we've seen with ECF is that it works as a great marketing tool indirectly. So what we've seen from past campaigns is that up to 40% of investors actually becomes new customers of the company that's raising. And that's very good conversion rates and good for the business of the company that's raising as well. Because it makes sense, right? If you're invested in a company, it's only natural that you go on and use their product. And it's applicable vice versa as well. We've seen customers become investors as well. Just because if you're having coffee from your local cafe every single week, wouldn't you want to invest in their company as well? Of course you would. And the other thing about ECF is to do with the nominee structure, which I'll let Izwan talk about later when we have the fireside chat. So to get started, if you like to register and you like to keep up to date with our latest deals, go to Leet Capital, click on sign in, and then click register account, click I want to invest, fill up a bit on your personal details, and then a bit more about your personal details as well, like your IC and your phone number, and do upload your front and back copies of your IC. We will need that regardless of what what type of investor you are. And this part is really important, selecting which investor type that you are. Um, so if you're an angel, if you select angel investor, sophisticated investor, we do require some supporting documents to verify this. You can see there in the description that these are the guidelines given to us by Securities Commission. So there are certain thresholds in terms of how you can meet this investor definition or this investor types. So if you do select those two investor types, you do need to submit along some supporting documents to verify this. If you do select retail investors, front and back copies of your IC would suffice. And that's pretty much it. That's really how you register on Leet Capital. So Izwan, I guess before we get started, we'll have a poll, and just like we did the last time as well. So the first question is, the people in the audience, do you have prior experience of investing in the private equity market? And if you do you understand the legal documents and terms that are involved in this space? Of course, if you don't have any experience, you can click not applicable for the second one. So I'll just give everyone a couple of minutes to answer the questions. Okay, cool. Looks like we've got a mixed bag of answers. Half people have not really invested in the space. So interesting to see that. Cool. Thanks everyone for answering that. So Izwan, I guess for the benefit of the audience, do you mind giving a bit of introduction to yourself as well as a bit of your background?
Well, Jasdeep, thank you so much for having me. Happy to be here. As always, I'm Izwan. I run a law firm based in Kuala Lumpur. I am a corporate lawyer. I've been a lawyer for the last close to 12 years now. Almost two-thirds of my entire legal career, I work in a large firm. So we work mostly with the corporate transaction, the stuff that probably you read on the news, and after so many years working with large companies, dealing with all the large transaction, I realized that I actually enjoy working with startup and entrepreneurs a lot more. So that's where Izwan and Partners started really the last 2 years. It's been very exciting journey for me. I found a lot of joy working with early stage entrepreneurs and founders. So as a law firm, obviously fundraising is one of the areas that we work a lot with on the legal side, whether or not you are an investor, whether or not you are a venture capital trying to consider an investment in a company. So we help with the necessary legal due diligence, making sure that the company does not have any major red flag and so on. Or whether or not you are a company or founder raising money for the first time, you've got a group of angel, family, friends that wants to put in a sum of money and you need to get a lawyer to help draft the necessary document. That's where we come in and help as well. So just a bit about myself. So again, thanks for having me.
Okay, cool. And I guess tell us about your angel investing journey so far. Do you invest in private companies? And if you do, tell us, share a bit about your first, I guess your first experience in doing so.
Well, thanks. I mean, I am an investor, although just like Suresh, the first speaker that we had last few weeks, we do have. I am a professional, so I do have a certain risk appetite in terms of the amount of money that I'm willing to invest. So anything below 100,000 ringgit is something that I am able to take a look, and that's always been the general a statement that I always make, because that's something that you also should be doing as a founder, right? If you're raising $500,000 ringgit, you don't go and speak to one person. You need to speak to a group of people. So I do invest in both, not just unlisted shares, but also in the normal public market as well, in listed shares. So I don't have a particular and I do have a general preference to certain industries like education, agriculture, and fintech, just like many investors may have a certain area of interest. So these are the area of interest that I have. And one investment that I did with all the other crowdfunding investors, I think there were 100 investors that invested in this company several years ago in a education tech business, one of the ECF platform. So at that time, Leet Capital hasn't gotten the license. So so I invested in that company, and it has been very interesting. The founders, the management give regular updates on a yearly, semi-annual basis. It focuses on the new digital education. They had a 3D printing uh, um, class. They had VR goggles, virtual reality, and teaching coding skills. Unfortunately, the pandemic really put a spanner on their business model. So all the contracts that they had last year with all the major public private universities were cancelled, and now they are pivoting into mostly online courses and digital services. So that's also the inherent nature of a startup business, right? Even the traditional brick and mortar businesses were also not spared last year, and that was my first investment several years ago. Looking at a few now together with you guys as well, the one that we just had a chat several days ago, and it's very exciting. I mean, obviously, I am lucky in the sense that working as a legal counsel in this ecosystem, once in a while we do get interesting deals that come by, and we do, just like Silicon Valley law firms, we also try and open doors for our clients to potential investors and network. So that's how I try to add value in the ecosystem.
Okay. And coming back to the part where you're actively looking at a new opportunity, startups investing as well. So I guess how what's your thought process like of identifying a good startup to invest in? Is there a certain industry that you look at, or is there something that you specifically look at?
Yeah, so obviously, as an investor, the best investment you can make is in yourself, right? But that's what Warren Buffett said, and obviously, Warren Buffett is more involved in public securities. But be that as it may, his general advice could be applicable to a lot of investors out there, and that's what I think a lot of investors do not neglect to do when they jump right into the investment game without really understanding their own risk appetite, what is the investment horizon that they're looking at, or what kind of strategies that they are looking at when it comes to investing in a particular asset class, whether or not it's shares in a listed company, whether or not shares in a startup, or even in a specific asset class, whether buying gold or cryptocurrency and so on. So in my scenario, I've made a quite it all boils down to the investor as well. I mean, there are investors out there, when they made an investment in a company, they'll just write it off as if that the investment was never made. So it all boils down to your own philosophy as to how you approach the investment. I know some investors are very particular in terms of how once the money is invested, they want to have granular, regular details as to how their monies are being spent. But if you're doing that for one or two company, perhaps you can still manage that. But if you're invested in 10, 20 companies, it's going to be very challenging for you to manage and monitor the investment. I mean, a lot of us do not have the infrastructure like perhaps what most VCs like Leap Venture or all the other sophisticated VCs may have. So as Angel, we do have an inherent challenge when it comes to a lot of issues surrounding deciding on the investment, like what you mentioned earlier, the methodology itself. There's so many ways on how you value a company. There's so many ways on how you assess how much is the investment amount that is worth investing in a particular startup and so on. So generally speaking, we all have to sit down and really ask ourselves, what is our risk appetite? Are we okay if the investment that we made is going to be loss making and so on? Because even if you look at the statistics and all the VC's investment, out of 20 investment that are being made by a VC fund in a particular time fund life, out of 20 they are looking at least 20 30, only 2 or 3 that will essentially cover all the losses of all the other investment that may not generate the exceptional return that they're looking at. So that is the general, I think, idea that you need to sit down and really understand the objective of you investing in a startup. So for all of us, obviously, when it comes to investment, we are looking at having a certain kind of return, and that is the return that you need to be looking at, right? I mean, obviously, if you're investing in a VC fund, for example, as an investor, as a limited partner, the average industry standard that you're looking at is at least 2 or 3 multiple of investment capital, which is the MOIC, which is not trying to get into technical here, but essentially if you're invested 100,000 ringgit in a VC fund, you're expected to get X amount of 3 times or 2 times of the invested capital minus whatever management fee and the carry interest that is to be paid. So again, you need to sit down and ask yourself when you're investing in a company, what is the objective here? And obviously, the purpose of us having this conversation is really looking at investing your hard-earned money or your capital in return for a certain decent return. Because if you're investing because you want to support your friend, if you want to support your family member or whoever, then it really does not matter anymore as to what is the valuation, because the valuation is an important discussion only when it comes to a serious financial investor that is looking to hoping for investment return on their capital.
Yeah. So I'll hold you aspects of investing in. And I guess just walk us through some of the common pitfalls we've seen investors face in this space.
Yeah, that's a good question, Jasdeep. I think in my experience, I mean, I've been very lucky and grateful in the sense that we dealt with a wide range of character and people in our work as legal counsel, working a lot with early stage entrepreneurs and founders. And we do have an interesting bunch of investors as well. I mean, a lot, and every time when we speak to a first time founder, we always encourage them to really understand the characteristic of the potential investor that wants to invest in their business. And obviously the temptation is very strong for a lot of first time founders to, when they've been going out pitching to so many hundreds of VCs and investors out there, and finally they got the term sheet that they really wanted, and a lot of the time first time founders would just sign whatever that is being given to them. And obviously, so long as you're working with a reputable venture capital or investor, and that's generally is okay. I mean, just that we always encourage you to go and speak to a legal counsel to take a look at the terms, to make sure that the terms that you're signing are industry standard. And this is something that I'm speaking from a perspective of a founder or a startup receiving the investment. But from an angel or investor perspective, a lot of investors do not really understand how investing in a startup or private company work, because it's not like buying shares in a listed company where you set up a trading account with a brokerage and you can put your money in the trading account and you can just buy shares and everything gets sorted out in T+3 depending on the settlement date, right? So investing in a private company is quite different, where you need to get the company secretary of the private company to get the necessary resolution, making sure that the shares are issued correctly and so on. And there are certain timeline that needs to take place before this is completed, usually at the latest, the fastest, between 2 to 3 weeks, depending on the agreement that has been made between the parties. So the first one is the understanding of fundraising law and also the company's law. So if you're dealing with an angel that may not be corporate savvy or technically savvy when it comes to this area, it may be a challenge for you. And also a lot of investors as well. Obviously, angel investors, a lot of professionals, engineers, doctors, even lawyers are looking at all the successes of unicorn companies, and they also now want to allocate a portion of their hard-earned income fees that they get from their trading or from their trade or profession to invest in startup. But but many of them don't really fully appreciate that. Again, it comes back to the awareness and education, right? And we had scenarios where an investor investing 100,000 ringgit next year, asking for the startup to give out dividend and so on. Just to give a perspective, even like today, Google or Apple, I don't think even Amazon never declared a dividend, because the game or the perspective of the company is quite different. It's about reinvesting the profit or for future growth and so on. And that is something that is important, having the alignment of interest between the angel and the company founder in terms of what is the intention of the angel investing in the business. So once in a while, I do tell founders that it may be easier working with venture capital to a certain extent, simply because if you're talking to a VC, you always know it's all about the money. If I'm investing 100,000 ringgit, you know that the next 3 years or 4 years, the VC wants to exit from your company and sell the shares at a 3 times or 4 times. But if you have an angel investing in the business, it's all about understanding the intention. And if the angel is the first time angel, then it could be more of a challenge to really assess the intention. So that's more of a the characteristic aspect of it, Jasdeep. So
Okay.
whether that answers that question on
Yeah. So just I guess following up to that question, when it comes to I guess negotiating the terms, right? It's always of course founder versus investor, right? So how does an investor investing in a startup, how do you balance that? How much can you actually ask in terms of rights or privileges as compared to the founder's perspective?
Yeah, so that is the challenge, the constant challenge that you have to grapple with every time you're accepting money from a third party or a shareholder. So unfortunately, when you're signing a contract or any agreement, there is no such thing as an equal contract where both parties have equal rights, in the sense that I have X, you have the same thing, and there are always certain trade-off or compromises that needs to be made, and the agreement is a reflection of those commercial terms that have been agreed. So it all depends on, which is why again, having a legal counsel or someone that has gone through fundraising before would be particularly useful to be able to highlight to you, based on the term sheet that you receive, which is the initial document that you get when an investor has decided to invest in a company, will give you a good indication as to what kind of investor that you are going to have in your business. And obviously the investor is putting a X amount of cash. The investor wants to have protection in terms of how perhaps the business going to be run according to what promises that you have made initially when you did the pitch. You don't want to end up as an investor, you don't end up in a scenario where the founder said that they're going to do this, and then once they receive the money, they end up changing the business into something else. And that's, for example, a clear-cut scenario upon which, as an angel or as any investor, you want to have a say in terms of change of business direction. For example, if a key co-founder decides to leave after a month after getting the money, what happens to the departure of that person? For example, if the company wants to hire someone and pays the person 20,000 ringgit or X amount of ringgit, would that be a fair appointment? These are the usual things that the investor would want to have a say, because obviously you're taking in money from another person, an investor, and they don't want the money to be spent in accordance to a certain expectation, and that's where the business plan and all the other things will come to play, to give a general idea in terms of how the business is going to be operated. So to answer your question, there are the certain clauses that will be expected in a term sheet or the agreement, which is why again, first time founders, we really encourage you to go get a lawyer to help you go through the terms so that you know exactly what you're signing up for. We do hear some horror stories about unscrupulous investors out there that try to take advantage of innocent founders and so on. Obviously, the contracts are there for a reason, is to record the understanding between the parties, which in the event of there is a disagreement or there's a dispute, you have the agreement to fall back on. The reason why we encourage you to have an agreement is obviously because the company's law, which is the legislation that covers the rights of the investor as a shareholder in the company, may not be adequate enough to protect the investor's rights. So things like information rights, for example, you want to be up to date about the company's latest management accounts, whether or not the report needs to be made on a weekly basis, on a monthly basis. These are contractual rights that can be incorporated in the agreement. So some investors do not wish to become a director because of the liabilities that may come attached to it. You can request for a board observer seat where if there is a board meeting, the investor has the right to attend and present his views, for example. So this is why having an agreement is important.
Okay, thanks. So yeah, so I think now we move on to the ECF part of it. And so I think a lot of investors in ECF campaigns, they invest purely for the business. As I think when it comes to actually the offer terms, I think valuation is normally the key one that we get from investors. But other than that, right, I think understanding the legal documents when it comes to investing in an ECF campaign is very important as well, whether it's with the ECF platform or with the company itself, right? So could you just walk us through some of the documents an average investor in an ECF campaign would see, and some of the terms that they should be aware of in these documents?
Yeah. So as an investor, you are responsible to read and understand the contract that you're signing for. There's really no exception to it unless you hire another person, a legal counsel, or somebody else that you trust to help you do the work. But ultimately, it is your money, and you should take ownership of the investment decision that you made. And the reason why the warning statement and the risk disclaimers are there in the platforms is for a reason. It's really to highlight the risk involved in investing in an unlisted shares. So again, to quickly recap, agreement sets out the understanding between the parties and how the parties will govern their relationship. So it could be between the company that is raising funds on the ECF platform. So there should be an agreement, the platform agreement or the issue agreement that sets out the terms of engagement by the company engaging the ECF platform, for example. So generally speaking, there are three documents or agreements that will be important when it comes to ECF campaign. Number one, which is the most obvious, is the term sheet. So the term sheet essentially is a snapshot. It's a snapshot of the key terms of the investment by the investor in the startup. It will set out what will be the minimum amount that the company is planning to raise. It's very pertinent that it is specified there because the way how our SE, the Securities Commission, the regulator has imposed is that the minimum amount is the amount that the company needs to raise, or else the investment will be refunded. So in other words, if you say that you're going to raise at least 100,000, you need to raise at least 100,000 ringgit before or else the campaign will fail, for example. And also the amount of maximum and also the amount percentage that will be issued by the company, which will also state the valuation before the investment, whether it's pre-money and also the post-money, depending on the outcome of the investment. And essentially also for the investor to assess what will be the minimum investment amount that I will need to put in for me to be eligible. And it's very interesting the last several years where issuers are becoming more creative. Obviously, I don't want to say these are sweeteners, but it's more like a additional encouragement for early stage investors to come in, giving out so-called bonus shares, giving out additional benefits in terms of discounted rates or packages to whatever product or services that the company may offer. So these are the additional terms that probably you will not get if you invested in a listed company apart from attending the EGM, and you do get some coupons and so on, but not now with the AGM being done online. I don't know whether people still do get that as a public listed company shareholder, but so the term sheet is a good indication as to what are the terms that you'll be getting And the second one is the shareholders agreement. So generally speaking, the company may not have an existing shareholders agreement depending on the company at the time of the crowdfunding campaign being hosted. So it is common for a lot of founders not to have things in writing. I mean, obviously, as an early stage company, getting a lawyer involved to draft document could be quite costly and so on. So a lot of the time, founders may probably have a simple term sheet just to cover this. So a lot of ECF platforms now do have a standard template that can be used for this. Again, as an investor, all these documents will be made available for you. It is now incumbent on your it is imperative for you to go and sit down and read them and really understand your rights and obligation. You can't say that I do not know about all these things, because they are actually there for you to see and for you to download and print it out for you to read and understand. So if there is no existing document, the founder may either use a template or get a lawyer to draft one, for example. So if the company may have received some investment previously from a VC, from a more sophisticated institutional investor like a corporate, for example, the company may already have an existing shareholders agreement, and then the question then would be whether or not there will be some clauses in the agreement that will be amended or revised to reflect the terms for the crowdfunding investors. And that is where the third agreement becomes crucial as well. So obviously, as a company, there's a limitation as to how many shareholders that can be that you can have in a public company. That's only limited to 50 shareholders. Although LLP or limited liability partnership is also permitted to raise funds on crowdfunding campaign, we still encourage startup to set up their legal entity as a private limited company, simply because of the inherent nature of private limited company, with distinction between a shareholder, director, and all the different instruments that you can issue, compared to a partnership where you don't have shares, but you use interest and so on. So the nominee agreement is very important, because the nominee agreement sets out the terms upon which you as a crowdfunding investor is appointing the ECF operator or its another administrative entity to help hold the shares on your behalf. And there is no hard and fast rule about this, but obviously most ECF platform have a general terms now. So again, as a founder, you do have a certain prerogative or discretion to decide whether or not, as an angel, depending on perhaps the investment amount that the angel is putting in, the investor may request for the shares to be held under his personal name, for example. So again, it all boils down to the discretion of the founder. You do have certain latitude of flexibility to dictate. It is important to read the nominee agreement carefully together with the shareholders agreement, because it does sets out the responsibilities as the nominee, which is a feature perhaps only peculiar for ECF campaigns, because to facilitate the scenario where the company may end up raising money from 100 investors or 150 investors, and the company's law just does not have the ability to hold more than 50 shareholders in the company at a particular time. So that's where the nominee entity comes in. But as far as the law is concerned, although you have indirect ownership of the shares, the nominee agreement aims to mimic or reflect your ownership in the business. Some of the things that are not taken out will be things like being able to attend a general meeting if there is a meeting going to be held. Although to a certain extent, your investment in a crowdfunding campaign generally a passive one. You don't have a more active role, but again, these are the things that perhaps the more sophisticated angel will probably have more leverage, depending on also the amount of money that they're investing. The sophistication of the due diligence or the question will also be important. But again, a lot of people don't want to trouble themselves too much. They like a business, they don't want to trouble themselves going through all the hassle of doing a full audit because all the documents are there. And you need to make an assessment whether or not the minimum amount fit your risk appetite and so on. So again, these documents are there. These are not cast in stone. As an investor, obviously, you have the ability to request for the change of terms and so on. But again, ultimately, it all boils down to the leverage, right? Depends on how much money you're investing. If you're investing a large sum of money, obviously, if the founder wants your money, then obviously they need to make certain adjustment and amendments and so on.
Okay. So coming back to the nominee agreement, right? Because it's so unique to ECF. What rights do I have as an investor? Because now my shares are being held by the nominee company, right? So how does that differ in if I was to hold my shares directly rather than going through a nominee company?
Yeah, so that's why the perhaps a lot of confusion, or maybe a lot of, I do not know whether we need to do a survey on this, whether or not investors have general reluctance to invest simply because the shares are not held directly through a share cap, from a share cap perspective. But generally speaking, although notwithstanding that the shares are not held directly in the target company or the issuer, the nominee agreement sets out clearly that the nominee entity has certain fiduciary duties or responsibility to ensure that the terms of the shareholders agreement are complied with. For example, ensuring that the accounts and the management accounts are duly furnished to the investors within certain prescribed timeline, for example. Again, as an investor seeking to invest in a startup, whether or not it's through an ECF round, whether or not it's through a VC, you need to read the terms to make sure that you're satisfied with the terms that you're investing in. And there've been a lot of time where it's okay to walk away from a company because you're not agreeable to certain terms, and that's something that you need to accept. I personally do not think the nominee set up in itself is a deal breaker, in the sense that it's merely a feature that is being created to facilitate the restriction or limitation of the current company's law. So for all intent and purposes, the rights as an investor, as a shareholder, are enshrined or set out in the shareholders agreement. So please take time to read it carefully, and again, get a legal counsel or some trusted friend to help you go through the terms, because it's your money, it's your hard-earned money. You want to invest in a company that not just good in management term, but also ensuring that your rights as a shareholder is captured in a manner that you wish to have them, especially your exit and so on.
Okay, thanks. I guess we'll take some of the questions from the chat now. The first one is by Ijam. Are you guys moving into more Sharia? I assume that's for Leet Capital. So yes, we are exploring that option. We've been speaking to a couple of vendors in terms of what are the requirements needed in terms of a checklist of to be Sharia compliant. So we are exploring that space and evaluating if it's something that we want to get into. And the second question is from Asnam. I think the SC Capital Master Plan released something on safes and the introduction of safes. So I guess he was just asking your thoughts on it.
Yeah, thanks, Asnam. Very interesting question, and I'm quite excited as well about the announcement from the ASC. Once ASC makes a formal announcement on this, I think one of the key challenges, again, this is where I think Jasdeep will be talking about valuation at any point in time shortly, but one of the key challenges for a lot of angel investors or even pre-seed seed investors from VC standpoint is to value a business. It's very hard. Sometimes you need to do a baseline, and obviously we can spend the whole day arguing what is the best way to value a company, right? Whether or not it's a startup or even a listed company for that matter. So SAFE obviously is going to be one innovative instrument to address this issue on valuation. However, we do have some variation of SAFE also in this part of the world. So obviously, SAFE in itself, a simple agreement for future equity, was popularized by a large Silicon Valley incubator, accelerator, Y Combinator. So a lot of the time we do come across these templates being shared with us, but unfortunately, the Malaysian law, or the Singapore law for that matter, it requires a lot of customization and changes that needs to be made. Be that as it may, does not mean that the SAFE is in principle is not workable. It's just that you need to get a local legal counsel to customize it to make it work. And also another challenge that we also realize is that a lot of the founders themselves do understand from a conceptual level how SAFE work, that it allows for an investor to invest in a business without dealing with the share issuance upfront or valuation. But when it comes to the more complex things like the discount rate or the valuation cap, that's where the founders themselves get a bit mixed up and confused. If the company already has a valuation, then there's no need for a SAFE document in the first place. The valuation cap does not seek to achieve that purpose, which is more rather a discount or to compensate for the opportunity cost for the investor taking the risk of investing in the business with no visibility as to what is the valuation of the business. So these are the things that, unfortunately, the irony of the SAFE is that in Malaysia or this part of the world where the document seeks to avoid the involvement of a lawyer as much, because it needs to be simplified, easy, cost-effective approach. But when it comes to implementing here or Singapore, you end up spending a lot more time going through the terms simply because the founders themselves do not really appreciate the mechanics of how the clauses operate. And the worst thing is you end up in a scenario where you may end up giving a lot more shares than what was intended to be the case if you do it through a normal shares issuance. So again, I know it's a very long answer to a simple question. We all looking forward to the Securities Commission issuing some more formal, definitive announcement on the use of SAFE in Malaysia. Other interesting instrument like convertible note, that like the Keep It Simple Security by 500 startup is another one. So there've been a lot of variation, but again, just as a general rule, there is no standard SAFE. There've been a lot of variation of SAFE over the past several years. Whatever SAFE document that you're looking at, you need to sit down and read carefully so that all the terms are acceptable, not just by the investor, but also you as well as the founder that is receiving the cash for the company.
Yeah, so I think we've even been speaking about safes last week or last week we were talking about that, and we have
Yeah.
invested in a couple of
So in a more jurisdiction, I mean, this is not something new. In the US or in part of the world, you do have this thing called crowd safe. So that's going to be quite interesting as well, where you bring in a number of investors coming together to invest in a company like a crowdfunding campaign, but it's just a promise to issue shares at a certain valuation in the future. That could potentially address the challenge that we have right now with company being overvalued, undervalued, or so on.
Yeah, but I think with safes because normally safes are for this more angel investors, right? We rarely see a retail or a public investor, the general public coming into a safe. What do you think about crowd safes then? Would it actually work? Would a regular person understand how a safe work, and would they be comfortable?
Yeah. So, I mean, well, that's the challenge that we all have to grapple with. A lot of first-time investor may face challenges, even in status quo, when it comes to dealing with the current investment instrument. I mean, every week you need to sit down and explain the differences between ordinary shares, preference shares. So obviously, it is a growing ecosystem, and it's very encouraging at the same time to see a lot more angels wanting to participate in early stage investing. However, generally speaking, like what we mentioned earlier, in principle, there doesn't seem to be any issue for us to implement a crowd safe structure. But again, the fact that ECF platforms are regulated by the SC, will still need to go get their blessing and see whether or not there's any complication under the capital market securities laws. But that's also, it's not really a legal issue, but more rather getting the investor to appreciate the risk involved in the different investment instrument involved, whether or not ordinary shares are more preferred, whether or not preference shares, and so on. Whether or not it's a safe note, whether it's a safe or whether or not it's a convertible note, for example. So yeah, that is the challenge. And interestingly, there are a lot of materials you can read on the internet about all these different features. Again, the challenge is the the knowledge of the investor as well is also key, and probably that also differentiates between a first time and a novice angel or sophisticated angel, because the understanding of the subject matter, the industry, will probably a lot more, and it's not just about the money per se, it's also about really understanding how does the investment would propel to a certain manner in terms of what is the angel looking at from a strategic standpoint of why he is investing in the first place, right?
Okay. And I think we have another question from Mr. Ong. I guess he's asking more sort of how to protect ourselves as investors, right? He's seen directors taking out 4 times of what the company is making. So how do we what can we put in a term sheet or a shareholders agreement to prevent this founders or management from using this money other than what the stated purpose was for?
Yeah, so thanks, Mr. Ong, for your question. Yes, even if whether or not you are ECF investor, whether or not you are a normal investor, there's this clause that you can include in called reserve matter or affirmative vote. So every year before the company starts its new financial year, there is a business plan that needs to be tabled, and in the business plan, it should set out clearly in terms of how the funds are going to be utilized. So a lot of the time, obviously, financial control is one of the challenges that a lot of investors may need to navigate. This is where perhaps the VCs are more sophisticated in terms of ensuring that the funds are utilized in accordance to the purpose of the investment in the first place. And obviously, you can incorporate contractual terms and obligations for the founders to only use the funds for specific purposes. There are contractual terms that you can incorporate. So again, I mean, obviously you have all this contract in place. You also need to really look at, understand. I mean, these are the things that I do not know from ECF standpoint. We need to do a survey whether or not all these things are being asked by the investors before they invest in the company, right? I mean, obviously to a certain extent, the founders do need a certain form of autonomy or ability for them to navigate and run the business and use the money in a manner that perhaps they feel best serve the direction of the business. At the same time, people need to get paid, and at the same time they need to get remunerated, and whether or not the amount is excessive or it's too little, and that's where the challenge is. And we do have control measures that we can incorporate in the contract terms, like having a reserve matter in the shareholders agreement, which allows for the veto rights if the amount is exceeding certain amount of every month. If it's above certain threshold, you want to appoint someone as a CMO or CTO or CEO, you need to get the investor to approve, or else it becomes a breach and so on. So yeah, it is a challenge, and if you're not happy that the term sheet does not have that restriction, you may not want to invest in that company in the first place. And obviously, these are some of the red flags that you need to be looking at, right? If you have access to the audited account, that will be available to you. You can look at the director's fee. You can look at the amount of fees that are being paid to the team. Even if the company does not have an audited account, the company's incorporated less than a year, the director will still need to furnish the management account. So it's more of an integrity issues. You want to work with honest founders. You don't want to work with dishonest founders. People, founders that like to exaggerate the numbers, the so-called people that likes to amplify things that may be small but may not become big. And these are some of the red flags that you need to be careful about when it comes to investing. We're not saying that as a founder, you shouldn't get any single cent at all just to feed yourself without living too luxuriously. But at the same time, you should be able to draw down a portion of money for you to be able to have a certain basic uh, uh, um, cash flow for yourself. So that's where, as an investor, it may be to a certain extent a good idea to also invest with a more sophisticated VC investor, because generally speaking, perhaps the VC would have done this kind of assessment before they decide to invest in the business. So things like that, and obviously the challenge that a lot of angels needs to address time and time again is always the lack of information and lack of data for them to make an assessment as to whether or not they should invest in a business. And again, if you're really serious about investing, about parting away your hard-earned money, you don't want to really sit down with the investor, with the founder, and visit their shop, go and see them, sit down, have a conversation. I do not know why people don't do this thing. Obviously, there's a time and cost involved in doing all this thing, but if you're really serious about making yourself satisfied before investing in a startup or business, you do want to ensure that the founders that you're working with will be around and don't end up floating and so on. So why should there be any different if you're investing in an early stage company or a normal company for that matter?
Yep, totally agree with you there. I think we've seen a lack of that investors going and actually meeting.
So I mean, you can't possibly rely on like 10, 15 pages of a pitch deck to decide on whether or not you want to put 50,000 ringgit or X amount of money in your in a company. You want to go and sit down and so on. Just like when you want to decide you want to buy something, for example, you want to sit down, really assess the market. So it is exciting and challenging at the same time. It is exciting because there's always something new to learn, and you get to sit down and really educate yourself about the new industry. Every time there's a new campaign being published on a platform, you get the ability to really sit down and assess whether or not it fits your risk appetite. And it is okay to say no to a particular deal because it just doesn't feel right for you, and just and there's always a new deal that will come again in the future. And having that realization and appreciation, for me, I think it's quite pertinent.
Yep. Okay. And coming back to the sort of the legal documents, right? The term sheet, nominee, shareholders agreement. How does this differ in terms of ECF investing in an ECF campaign as well as VC investing? Of course, the nominee structure would not be applicable most of the time, but I guess in terms of the other documents or specifically the terms involved, how do they differ?
Generally speaking, the raising funds from a founder perspective, if you're raising money on a crowdfunding campaign, is actually more structured. So every platform would have a certain processes or process flow that needs to take place. The first introduction, whether you meet the platform event, whether you send an email, they send you a checklist of what are the documents that they need. And after passing through this initial screening, the platform feels that you could be a good fit, and they'll send you an engagement letter. Whether or not you agree to the engagement letter, there's a bit of fee that you need to pay to get yourself onboarded through the platform. And the next step would be to get the initial pitch and the deck, business plan. These are some of the documents that are required. They are not very extensive document, and depending again, even ECF platform do have their own appetite in terms of what kind of business that they want to 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 approve in the business. So that's another thing as well. So once the campaign is onboarded, then you can go live. Then it allows you to essentially promote your business to the public for them to invest. And again, obviously, if you want to invest in a company on a crowdfunding campaign, you need to be a registered investor in that particular platform as well. So the key difference perhaps is that the ECF round is more structured. The platform will tell you exactly this is how we want to going to host your campaign. This is the process. It takes X amount of days and so on. It's more flexible as well to the founders. So as a founder, you do have a large, significant autonomy to dictate the terms of the investment. If it's led by you, you are the founder with another co-founder, there's no other investor yet in the business, you can actually dictate this is how we want to offer the terms to the investors. So you can have more founders friendly terms. And obviously, like what Jasdeep mentioned, you mentioned earlier, that there's more visibility to the market, unlike a VC round where everything's done in a very hush-hush, discreet manner. There's an exclusivity clause that you sign, the confidentiality clause, you can't disclose to anyone that you're talking to this particular VC. But the ECF round is actually more prominently loud. Like every day, every month, you will be showcasing your business, you're linking up the link to your crowdfunding campaign and so on. So obviously, the more sophisticated the investor that you're talking to, the more lengthy the discussion and the process is going to take place. Obviously, you're talking to an institutional investor, I'm talking about venture capital or a corporate for that matter, strategic investor. There are internal processes that need to take place on their side, because they need to go, and the analysts that found the company may need to present and pitch to their own investment committee and see whether or not there's more money left for fund deployment, whether or not the fund is actually deploying, whether or not the investment thesis fits the risk appetite of the fund vertical, for example. So that is something that doesn't really happen in the ECF round, because everybody who has an account with a particular ECF platform like Leet Capital can go to the campaign page and get a copy of the term sheet, really assess it himself. And again, the next step is where a lot of angels may lack or may not do, which is to actually sit down with the founders and have this face-to-face interview, or visit the factory, visit the shop, and see whether or not the things that the founders are claiming are actually there. I mean, whether or not the contracts that the founder claimed exist. These are the things that more sophisticated investors will do. They will engage us as lawyers to go and look at all this contract to make sure that the contracts actually exist, they have not expired, they are not been breached, and so on. And I just somehow fail to understand why, as an angel, you don't want to do all these things simply because you're an angel. You may be putting a smaller amount and so on, but there's nothing stopping you from actually requesting all these documents just so that you are satisfied before investing in the business. And these are the things that I think makes ECF more exciting for a founder, because it does give a more latitude in terms of dictating the terms. But at the same time, for an angel, you need to be satisfied whether or not the investment that you're going to make fits your risk appetite, and whether or not your investment analysis, you have enough data for you to make an assessment of whether or not it fits your investment horizon and strategy as well. So generally speaking, obviously, from traditional fundraising method, there's no fee that you need to be paid to a ECF platform. Unlike a ECF platform, there's a fee that needs to be paid. But even if that is the case, there's still legal fees that you need to pay to the lawyer. So most VCs nowadays do ask the company to pay for the legal fees, so there's still costs involved and so on. So those are the general key differences. One is the ECF is more structured. There's a certain visibility in terms of the timeline that needs to take place before the company is able to host its campaign, all the way to the closing of the campaign and when exactly you're going to get the money, less whatever deduction that needs to be made for the fundraising fee and all the other costs. And number two is the flexibility for the founders to dictate the terms of the investment for the investor that wants to be involved. And number three is that there's more visibility to the market and the public. Just like what Jasdeep mentioned earlier, that there's an indirect or direct PR benefit where it comes out on the news, it comes up on social media, and that's what makes it exciting as well, where people can come and see the business as opposed to a VC round or traditional method where it's actually more closed doors, more discreet, where you want to keep the deal to yourself because you want to be part of the next big thing, where ECF is more people coming together and being part of something big and trying to be part of that journey that you're trying to get your business off the ground. So those are the key differences.
Okay. I know it's 2 past 12, but I've just got one final question for you. I guess it's two questions combined into one. We have a question from the crowd asking, any guide for ROI for investment and what is the best time to exit? And I'd like to link that to the part on valuation, because of course, we've seen some ridiculous valuations in the market currently. So how do you justify is such a high valuation? Because obviously you're not going to get that ROI that you intend to if the valuation is so high, right? So what are your thoughts on that?
Well, that's the big question, isn't it? Jasdeep, I mean, that's why you're taking your CFA now, which is to figure out all this thing. And obviously, um, there are a lot of books out there that you can pick up, and a lot of resources and materials, even from larger, more respectable VC funds out there. There's so many articles written by uh, principals, general partners at Sequoia Capital, Anderson Horowitz, that you can just go and read them. I think obviously when it comes to valuation, generally there are only two ways on how you value a business, right? One is through a relative way, which is more common now, which is the estimate of the asset based on the comparable asset. So if you're valuing Grab, you're looking at Uber, for example, as a benchmark, and based on the common variable, whether it's through earnings, cash flow, or book value of the sales, or the more common one, which is the discounted cash flow valuation, which is the value of an asset. You're really extrapolating the potential earning of your investment from the day when you putting in the cash in terms of when exactly the business is going to generate revenue, and putting an assessment to that. And obviously, there is no such thing as a true value because all valuations are biased. We have a lot of inherent personal bias in terms of data risk and also our own personal bias on the business. And the question is how much and which direction that we may be biased. And also there's no such thing as precise value as well. You can get 3-5 different people to do a valuation. You can get a varying result. And again, generally speaking, simpler valuation model is better than the complex one. Don't try to complicate things. And the more variables involved, the more complicated, the more likely that the valuation could be wrong. So again, like what I mentioned earlier, if if you want to invest in a startup, please do invest in yourself first. Buy books, read books. So many books out there that you can read on valuation. Aswath Damodaran is obviously one of the key pioneer on valuation. You can go and get a copy. So many books that you can read as well. Understand the risk and the reward of early stage investing. If you're asking about what is the industry standard of the return on investment, that would be 2 to 3 times, which is the MOIC, which is the minimum of investment capital that you can get. So if you invested 100,000 ringgit, you should be getting at least 3 times the amount within a certain investment horizon. And do take note that the typical angel investor horizon, even in Silicon Valley, is 9 to 10 years. So if you're not willing to invest for that period of time, then you shouldn't really be investing, because if you invest today and the next 3 years you may need money because you want to do something, then it may be very unlikely for you to get your money unless you have secondary market trading and so on, because you're investing in a private company. There's no liquidity in the sense that you can't dispose your shares in the open market. Even if it's a public market, it all boils down to the valuation, whether or not the share price has gone up and gone down, because that will affect the realized losses that you could probably make as well. So generally speaking, obviously as an angel, like what Suresh mentioned last several weeks, the usual exit for early stage angel has always been a trade sale, where you have a larger investor, whether or not institutional, that sees the benefit of having ownership in the particular business, that wants to buy out the shares in. So it's either investment of new cash or the institutional buying out the existing shareholder, and that's where usually the angel could exit, whether it's a full exit of selling all the shares or the investment amount, the shares that you have received, or whether or not it's a partial exit where you want to continue to stay in the business as the business matures for potential larger exit through an IPO or another M&A, for example. Um, so yeah, I mean, these are the usual valuation method. I mean, it's not, I wouldn't say it's not complicated, but at the same time, it's not difficult as well. It does sound challenging, especially if you're scared with numbers, but there are actual spreadsheet that essentially have all the formula where essentially you just need to key in the variables for you to come up with the amount. But again, ultimately, all these numbers needs to be stress tested, and you need to really verify the data to make sure that they are actual verified data and so on. So that's where the exciting part of investing in early stage business comes in, because you get to be involved in all these things, and you need to be excited with the part and parcel of the investment. It's not just having X amount of return, but also the joy of making because but that's what valuation essentially means, right? You want to pay less than what the company is worth. If you're paying the actual amount of value what the company is, then there's that defeats the whole idea of valuation, because you want to pay something for what is less than what is worth, and that's what valuation essentially is.
Yep. So I mirror your thoughts completely. I think there are a lot of resources that investors could rely on when it comes to valuation. Like you said, Damodaran, king of valuation. I watch some of his videos as well. Use his resources. Yeah, he has so many videos online, free to use. Even his resources on like discount rates and stuff, they're all free to use. I rely on them as well sometimes. So if you're a new investor, go and read up some of his books, or go and use some of his resources that he has. So I guess that brings us to the close of today's session. Any final advice for the audience in today's session?
Well, the best investment you can make is in yourself. That's what I said. I mean, it's not what I said, it's what Warren Buffett said. But so do spend some time to understand the risks and rewards of investing, and really ask yourself, what is your risk appetite? How much money are you willing to put in for investment, and whether or not that will also affect your investment horizon. And that's what we're all doing, right? It's about opportunity cost in terms of assessing the available asset classes. I mean, that's, we got inflation and all the other thing, and that's what we're trying to address. Angel investing into startup obviously is one of the exciting asset classes that you can explore. Apart from other exciting new things right now with NFT and all the other cryptocurrency and so on, there's still actual benefit of investing in early stage company, apart from the usual financial metrics in terms of the potential return on the investment capital. There's also part of the joy of being part of something big, in terms of being part of larger next thing, for example, which is, for me, is invaluable, to put a value to it. And please take time. I mean, we have the infrastructure in place. We do have the Business Angels Network, which allows people to participate and join monthly pitching sessions for you to participate and ask questions as an angel. We do have a number of growing angel investors club. So if you are a single individual angel that wants to start but do not know where to start, there are all these different angel investment club that you can sign up if you are accredited as an angel investor. So you don't have to come in as an individual, you can come in as a group, 3-4 angel coming together to invest in the company to spread the risk or to diversify the risk. Perhaps you could be a doctor, another person could be a lawyer. So the doctor may have certain subject matter understanding of the industry that could help give an assessment whether or not the potential investment in the medical tech company could be a viable business, for example. So that's where you can leverage on other angels' expertise and share deal flow and so on. We all have limited amount of cash and funds for investment, and we need to be very selective at the same time. We also want to be open to opportunities, and that's where I think if you really spend some time and be patient and be open to opportunities, I think angel investing could be something that will be very exciting part of your investment journey.
Cool. Thanks for sharing, Izwan. So I guess this brings us to the close of today's session. So if you'd like to give us any feedback, the link is in the chat, or you can scan your QR code here. Thanks, Izwan, once again. I myself have learned a lot from today's session, and I hope the audience, you guys took some valuable lessons from Izwan today in terms of understanding legal aspects, and not just that, but overall in angel investing as well. And of course, if you'd like to stay up to date in terms of our next events as well, you could follow us on our socials over here. Thanks, and have a great weekend, everyone.